Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar.
Hey, good day, everyone. Welcome to another Cambridge podcast. This is episode 68, and last week we couldn't do one, and I apologize for that, but we had all the corporate taxes deadlines that were due on Friday, March 15th. So we were quite busy working Saturdays, Sundays, and working till 11 o'clock at night, midnight at times, in order to get everything done. So I'm happy to inform everyone that we were able to get them all done. We got 2 of them out of about 36 that we do for corporate companies and so forth that we had to get an extension for, but otherwise we did a really, really good job. So now we have the individual tax deadline, which would be for 2019 would be April 15th. So I'm hoping that most of you are either getting ready or you're already prepared to make certain that you're going to be able to file your taxes. So, with that being said, what I'd like to do today is take a few minutes of your time and kind of walk you through some of the changes and some of the opportunities that you may see under the new tax law that came into effect for the first time January 1 of 2018. So for those of us that are doing our taxes this year, remember, we're doing the taxes for 2018, and this is the first year that you're going to be exposed to the new tax law from a business perspective. So simply speaking, what I'd like to do is I want to walk you through the new 1040. It has changed a little bit. So some of the clients that I engage have some questions about, what are some of the differences and the changes and the opportunities? Is it as simple as it used to be in the past? And by the same token, toward the end of this podcast, I want to start to apply some of the things that you have learned and some of the education that I have provided regarding the 3 tax buckets under the IRS code: the taxable bucket, the tax-deferred bucket, and the tax-free bucket. And how do you start to understand where those taxes and those buckets fit into the completion and the filling of your 1040 forms? Now, for those of you that may not know, the IRS Form 1040 is in fact a standard federal income tax form people use to report their income, where they can claim deductions and credits and calculate the amount of their tax refund or their tax bill for the year. Now, in 2017 and before that, there used to be 3 varieties of 1040s. So you had the 1040 EZ, which was the simplest form that you could complete. You also had the 1040A, which was not as simple as the 1040 EZ, but was a lot simpler than the traditional 1040. And obviously those covered and were completed and filled out depending on the complexity of your tax situation at the time of filing. Now, for 2018 tax year, which we're now dealing with in 2019, the tax return you'll file will be just a 1040. Now, in addition to the 1040, there are 6 different forms or schedules that may or may not be completed depending on your specific tax situation. So when you look at the new 1040, it's a summary of some of the other 1040s in the past, and makes it a little bit simpler because of the fact that you're only going to be adding one or 2 or multiple of these schedules, depending on what it is that you need to do for that tax year, depending on your tax situation. So, for instance, Schedule 1 that you may want to add to your 1040 if you need to would be additional income and adjustments to any income that you may have. So, for instance, if you receive any alimony income payments, if you have any type of business income, you may also need to file a Schedule C along those lines, unless you have a duly corporation, and then obviously you would have to file either a partnership return, a corporate return, or an 1120 or 1120S return. But if you happen to be self-employed and you haven't incorporated, then you're more than likely going to file Schedule C. If you need to report capital gains or losses, you would use Schedule 1, and obviously you may also need to file a Schedule D along those lines. And then if you have any type of rental income, you may also need to be able to file Schedule E as well along those lines. What if you have any type of farm income or price or gambling winnings, unemployment income? For those of you that may have been unemployed during any portion of 2018. If you happen to be an educator and you have some expenses that are deductible because they're non-refundable by whomever you're employed with. If you have deductible moving expenses, the health savings account deduction, if you want to take that deduction, then obviously you're going to need to file Schedule 1. And obviously student loan interest and deductible retirement contributions. Now, for those of you that may need to file Schedule 2, those would be primarily for your non-refundable credits. So if you have any issues with an alternative minimum tax, or if you have any excess advance premium tax credit repayment on health insurance and so forth, you may very well need to file Schedule 2. Schedule 3 would be primarily if you want to claim any type of foreign tax credit or credit for a child and dependent care expenses along those lines from a business perspective. Schedule 4. Again, there are only 6 of these. Schedule 4 would be if you owe any type of self-employment tax. Let's say any additional taxes on IRAs, retirement plans, or any other type of tax favored account. Household employment taxes, repayment for a first-time home buyer credit, a penalty. If you didn't have health insurance in 2018, you would still have to pay the penalty under the old tax law. Now, starting January 1 of 2019, if you don't have health insurance in 2019, then you're not going to be liable for the penalty. But for 2018, you're still liable for that penalty. If you have any type of additional Medicare tax or net investment income that you may have to report. Schedule 5 would be primarily for other payments and refundable credits. From a business perspective, obviously, if you want to claim a refundable tax credit, or if you want to make a tax payment associated with getting an extension or excess Social Security withheld, obviously you would file Schedule 5. And then last but not least would be Schedule 6. And that would be primarily if you have a foreign address and you have a third-party designee, meaning that if you have an address outside the United States, or if you want to allow someone else to discuss your tax return with the IRS. Now, so obviously, you have the basic 1040 that you need to complete, and hopefully most of you are using a tax preparer, an accountant, and so forth to be able to do these for you, because they're going to be able to maximize your tax benefits for 2018. And if you're dealing with a tax planner, not only is he or she going to be able to help you with the tax preparation for 2018, but they may very well help you with your tax planning for 2019 and beyond. Now, the other question I get from clients is, what do I need to fill out my 1040? And obviously, you're going to need a lot of information to do your taxes, but there are a few basics that most people will have to get and collect, prior to completing your taxes with a tax preparer. Obviously, you're going to need your social security numbers for you, your spouse if you happen to be married, and any dependents that you may have. Dates of birth for you, your spouse, and the dependents as well. Statements of wages, your W-2s, your 1099s, statements of interest or dividends from banks and brokerage accounts and so forth. Any proof that you may have of any tax credits or tax deductions. Always is very important to always bring to the table to your tax preparer, especially if you're using a new one for the first time, a copy of your past tax return. And then obviously your bank account number and routing number for any type of IRS refunds and direct deposits. And so forth. The other thing is there were a lot of issues during the Tax Reform Act and the negotiations to bring the TCJA to the table, where they were saying that you could pretty much complete a 1040 on a postcard. And I would say, based on what I see, obviously, those were great promises, but, they're a lot more complex than the promises are always from a business perspective. But, maybe front and back, but otherwise, not only are you going to have your 1040, but you're also going to need to be able to provide some of those schedules that I just walked you through, as far as getting your tax house in order for 2018 and beyond. So obviously, as you start to prepare to do your taxes, make sure that you have all the information. By the way, for those of you that are using a tax preparer, make certain that you bring all your stuff together, that you have a spreadsheet, because it's going to make it a lot easier for your tax preparer, and it may also be a lot cheaper for you to be able to complete those forms, because at the end of the day, if your tax preparer needs to keep going back and forth, trying to gather additional information or getting missing information from you in order to complete your tax return, then obviously that's going to be reflected on your tax bill for the preparation of that tax return. So I would encourage all of you to get ready and get prepared. Usually what I do with all my clients that I do tax preparation for, at the end of the year, I send them a tax preparation checklist that will let them know, based on what they've done in the past with me, as to what it is that they need to prepare for and bring to the table in order to minimize those dreaded phone calls a day before taxes are due, just to gather some additional information. So when you take a look at your traditional 1040, the top part of it, it's pretty simple. It's primarily your name, rank, and serial number. The IRS, wants to know who you are. Obviously, make sure you use a name as it appears in your Social Security card. Make certain that your Social Security number is correct. There are millions of returns that are being returned, and both on the individual side and also on the corporate side, when it comes to tax preparation on an annual basis, because there may be a missing digit, or there may be a wrong digit on your Social Security. So make certain that when your tax preparer completes your tax return and then sends it to you with the 8879 for e-file approval, that you review it first before you sign it, because at the end of the day, it will be your responsibility for all that information that is inside that tax return. So obviously your first name, your initial, and your last name is going to be very critical. Your filing status is also very important. Are you single? Are you married, filing jointly? Are you married, filing separately? And there may be a reason why you may need to do that. Are you filing as a head of household, meaning that you're the single provider in the household, and you also have a dependent child or a dependent member in your family that you're taking care of? you a qualifying widower? So those are things that are very, very important, but obviously make certain that you discuss it with your accountant and or tax preparer prior to completing all of the filing. Now, obviously, there's going to be some dependent information. You're going to have their first name, their last name, their social security numbers, and numbers. What is their relationship to you? Is it a son, a daughter, a parent, whatever that may be? Do they qualify for the child tax credit? Obviously, your tax preparer will be able to figure that one out. And would there be any other credit for other dependents along those lines? And then obviously, you and your spouse are going to have to sign that tax return at the very end. So it's important that you prepare, because if you prepare for your tax return, it's going to make it a lot easier, not only for you and your family, but it's also going to make it a lot easier for your tax preparation services as well. Now, when you start to go down the line on your 1040, line 1 is all about wages, salaries, tips. This is where the W-2 comes into play. Now, as we go through this portion of this podcast, just please bear in mind that I'm going to try to go back and emulate some of the things that we've talked about regarding the 3 IRS tax buckets. So you have the taxable bucket, the tax deferred bucket, and then obviously the tax-free bucket or the tax advantage bucket, as you may want to call it. So line 1 is all about your wages and salaries. So you need to make certain that you have the information on your W-2s readily available to put into the 1040. 2A would be about tax-exempt interest, and that could be, let's say, municipal bonds. You may be receiving the interest on that. And 2B now would be taxable interest. Taxable interest will more than likely be the interest that you're generating in your taxable bucket. That would be the interest that is coming to you from traditional mutual funds, let's say CDs, money market accounts, those kinds of things in which you're receiving a 1099 every year. That is part of the taxable interest. So, it's important to note, how much of that interest you're receiving, because at the end of the day, the more interest you're receiving out of the taxable bucket, the higher your tax liability for the year would be. And this is where you can really start doing some tax planning for 2019 and beyond. 3A would be about qualified dividends, and 3B would be about ordinary dividends. So again, those are things that happen in the taxable bucket, and be careful, understand, why it is that you have the money there. Do you have the money there just to fulfill the emergency fund minimum requirement or liquidity? Do you have the money there because you're thinking about a strategic purchase in the very near future and you need to have liquidity on your side of the ledger? Or do you have the money there just because? And if it is just because, well, would it make sense for 2019 and beyond to move those assets to the tax-free bucket in order to avoid the tax liability that you're now having to pay for 2018 because of the fact that you had the money in qualified dividends and obviously in ordinary dividends as well. 4A is all about IRAs, pensions, and annuities. So that means that now the tax-deferred bucket is coming into play. So that means that monies that are coming out of your IRAs, of your pensions if you're in retirement, or any annuities that you have coming out to you are now going to have to be reportable, and taxes are going to be paid depending on your tax bracket at the point in time that you complete this form. And then 4A is reporting all of that income that you're generating from the IRAs, the pensions, and the annuities. And then 4B would be the taxable amount of that income. Perhaps a portion of that income coming out to your pension may not be taxable to you, a very small portion. So for instance, if you made after-tax contributions to a pension system, then perhaps you'll be in a position where, as you get your pension benefits, 97, 98% of that pension benefit will be taxable, but you'll have that 1 to 2% that may not be, and therefore that would be the difference between the IRA's pension and annuities income on 4A and the taxable amount on 4B. The next one is 5A, which is Social Security benefits, and that's the Detective Columbo got you question. For those of us that are old enough to remember Detective Columbo, obviously that was a very famous show back in the 70s and the 80s, where he looked pretty old, and he looked pretty dumb, and he would solve every single one of the cases that he worked on, and many of the criminals, when he was asking them questions, felt that, hey, this guy is so dumb, I think I got him, I'm going to get away with murder or whatever. And then he would just keep asking stupid questions, and then he would say goodbye and then start walking toward the door. And as he was getting closer and closer to the door, he would stop, turn around, and say, one more question. And that was the killer question that he would ask, and then obviously he would have you at that point in time. So for the same way that I take a look at Columbo, I call 5A in the 1040 as the Columbo question, and the question in 5A deals with your Social Security benefits. So if you're in retirement and you're already collecting Social Security benefits, what is the amount of that Social Security benefit that you collected for the year? And then in 5B is what is the taxable amount of that Social Security benefit. And that's where provisional income calculation comes into play, and this is the one that we've talked about on many of the podcasts that I have done for you, as well as the seminars and the webinars and the online training that I do, because at the end of the day, when you're in retirement and collecting Social Security benefits, the IRS is going to do a provisional income calculation, which I do for my clients often, in which the IRS wants to know what percentage of your Social Security benefits is going to be taxed in retirement. By the way, you'd be surprised how many of my clients question the fact that they have to pay taxes on their Social Security benefits. Now, unless you've done proper tax planning, and that's where the taxable bucket and the tax deferred bucket comes into play. If you haven't done proper tax planning, up to 85% of your Social Security benefits may very well be taxed in retirement. Could be 50% of your Social Security benefits may be taxed in retirement if you did an okay job. But if you really did a good job in working with a tax planner, then 0% of your Social Security benefits may be taxed in retirement, and that would be the best possible world that you may find yourself in from a business perspective. By the way, for those of you that have to pay either taxes on 50 or 85% of your Social Security benefits, you may actually run out of money between 5 and 8 years sooner than expected, because you have to offset that tax that you're going to pay to the IRS on that Social Security benefit, which now is going to reduce the net income out of that benefit, and then it's going to force you to go into your tax deferred bucket and start pulling more money that you intended to from your IRAs and 401ks in order to offset that deficit. So it's important that you do proper tax planning, and the sooner that you start doing that, the better it is. Line A would be either your standard deduction or itemized deduction, and that goes attached to Schedule A. Now, if you're single, in 2018, your standard deduction is $12,000. If you're married filing jointly or qualifying widower, it would be $24,000. If your head of household would be $18,000. So it's important to know, because what I'm finding in the taxes that I've done so far this year, the vast majority of the clients that I'm engaging are actually using the standard deduction as opposed to the itemized deduction, because usually when you retire, you start to lose a lot of those deductions that you were able to obtain while you were working. So because the standard deduction is higher in 2018 than it's ever been in history, more and more Americans are opting in for the standard deduction as opposed to the itemized deduction. And then obviously as you get through all these lines, as you go down the line, when you get to line 18, would be all the total payments that you have made. So obviously you're taking your deductions on your W-2s, and you do that on a regular basis per payroll check. For those of you that are self-employed, I do encourage you to pay estimated taxes on a quarterly basis, because I don't like surprises, not even the good ones. So it's important for you to understand that if you have to pay self-employment tax, and obviously the IRS is going to force you to do estimated tax payments for the following year, and you don't want to fall trap to that. And then obviously in the following lines is going to be the amount of money that is either going to be refunded to you or you're going to have to pay. By the way, the average refund in the United States for 2018, in other words, the 2017 tax year, was about $2,800. And I'm always cautioning my clients not to try to take a refund. Now, if you get a refund for $300-$400, okay, that would be okay. But if you're getting a refund for $1,500, $2,000, $2,500, $3,000, $5,000, then that's not a good thing. You need to do proper tax planning, because basically what you have done is you have given the IRS a tax-free interest loan for the entire year, because when you owe them money, they're going to charge you interest, but when they owe you money, they just return that money back to you at no interest whatsoever. So it's important that you do your proper due diligence when it comes to your tax preparation, not only for 2019, but based on the 2018 tax year, but anything above that. And then obviously, one of the things that you got interesting in this tax return that I just went through with all of you is that there's no line on that tax return that would ask for any Roth IRA distributions, any Roth 401k distributions, any distributions that you may have been taken from a cash value life insurance policy, because those are not added to the tax return, because those are totally tax exempt. Not only are they tax exempt, but they do not cause any type of negative impact on the taxation of your Social Security benefits and or your Medicare premiums in retirement. So the better job you do in tax planning, the better job you do in moving as much money as you possibly can from the taxable bucket and the tax deferred bucket to the tax-free bucket, the better job and the better position you're going to be able to find yourself in, and you're going to be able to position your family for a well-funded retirement life from a business standpoint. Now, obviously, if you're interested in scheduling a video conference or conference call with me to discuss some of the things that we've talked about today, please feel free to do so. You may want to reach out to me at area code 786-766-1042. Feel free to also go ahead and send me an email if you want to, and you can send me an email at Bert, B-E-R-T, at GablesTaxGroup.com, and I'll be more than happy to answer any questions that you may have. And remember, my goal for all of you on a weekly basis, and we've done 68 of these episodes already, is to always kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. So again, thanks very much for giving me a few minutes of your time. I wish you all a wonderful tax season, and we'll talk again next week, because I want to continue to help all of you minimize your tax liability while you increase your benefits and your retirement benefits, not only for you, yourself, and your business, and not only now but also in retirement. So again, see you again next week. Take care. Bye-bye.